The 10-year Treasury started the week at 4.72%. And while it has come down a bit since then, it's still offering some of the highest yields since 2007 at the time of this taping on August 13th, 2026. With bond yields and also equity markets at such elevated levels, let's talk about a unique, not often discussed type of annuity that can lock in attractive rates right now and guarantee top payouts for later in retirement. And it may also help lower your required minimum distributions and taxes. Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. The guaranteed future income from many qualified longevity annuity contracts, or QLACs for short, continues to be higher at the current time than where they've been in a long time. And if interest rates remain at their current attractive levels, so might QLAC rates. Because as many of our Diamond NestEgg regulars know, annuity rates track long-term interest rates. So with that in mind, here are the 3 topics I'll be covering today. 1. What is a qualified longevity annuity contract, or QLAC? And how can you use it to lock in a guaranteed future lifelong income at current rates while reducing your RMDs and deferring taxes? 2. How much could a QLAC pay out monthly? And who might want to consider a QLAC? And 3. When might a QLAC not be the right fit for you? And what are some key factors to keep an eye on? Let's dive in now, folks. What is a qualified longevity annuity contract, or QLAC? And how can you use it to lock in a guaranteed future lifelong income at current rates while reducing your RMDs and deferring taxes? We regularly speak about 3 types of annuities in detail on our channel. The first is a single premium immediate annuity, or SPIA. With a SPIA, you make a single and usually large upfront payment to the insurance company, and immediately or very shortly after your payment, the insurance company starts paying you a guaranteed monthly income for the rest of your life. The second type of annuity we frequently cover is a multi-year guaranteed annuity, or MYGA. A MYGA is a type of fixed deferred annuity that is similar to a bond. With a MYGA, you pay a lump sum premium to the insurance company at the beginning of the contract term, and this lump sum amount earns a guaranteed fixed interest rate for the specific term of the contract, typically ranging from 2 to 10 years. And at the end of the annuity contract term, but not before, you get paid out the principal plus interest, at which point you can either withdraw the full amount in cash, renew the contract, or convert it into another annuity product, such as a SPIA. The third type of annuity is one that we've talked a lot about recently, as both equity markets and interest rates remain at very attractive levels. A fixed indexed annuity, or FIA. Like a MYGA, a FIA is also a type of fixed deferred annuity, meaning that with a FIA, you also pay a lump sum premium to the insurance company at the beginning of the contract term. But unlike a MYGA, with a FIA, the returns on this lump sum amount are generally linked to a market index, like the S&P 500, up to a certain cap and or participation rate, while your principal is protected against market losses, meaning that your principal and any amount that has been credited to your FIA account will be 100% protected against a potential market crash. And at the end of the contract term, you get paid out the principal plus earnings. Here again, you can either withdraw the full amount in cash from your FIA, renew the contract, or convert it into a SPIA for a guaranteed lifetime income stream. A fixed indexed annuity may be something to consider for those of you in our community who are worried about current stock market levels, but still want to keep a foot in the market without any loss of capital, without any loss of principal, in order to participate in any additional upside that may potentially come in the future. And as our FIA fans, whom we've been working with, know, with a FIA, you also have the additional option of locking in a guaranteed future lifelong income at what we think is a golden moment of both high rates and equity prices. This can be done via the purchase of an income rider at the same time that you sign your FIA contract. I've linked this recent FIA video below for those of you who want to learn more. Or if you want to see what the latest FIA rates look like whenever you might be watching this video, email us at jennifer@diamondnestegg.com to get connected with our trusted annuity specialists who can help you find the best annuity solution for your personal situation. So, A FIA with an income rider is a great segue into the fourth type of annuity that will be the focus of today's discussion. A qualified longevity annuity contract, or QLAC for short. A QLAC is similar to a FIA with an income rider in the sense that you put a lump sum premium into a QLAC today that grows tax deferred over the term of the QLAC. And at the end of the contract term, it automatically starts paying you guaranteed monthly checks that will last for the rest of your life, all locked in at today's attractive rate levels. A QLAC does not offer you the flexibility of a FIA with an income rider, though. It is designed to provide a guaranteed lifetime income starting later in retirement, up to age 85. And once you're locked in, you can't decide to take a lump sum payment instead of the lifelong income. You also have less flexibility to change the date when the monthly income starts. In return, though, a QLAC may help you to defer required minimum distributions, RMDs, and save taxes on this part of your retirement savings. More on this shortly. Here are the 5 most important things you need to know about QLACs. 1. The lump sum premium that you pay upfront to the insurance company for your qualified longevity annuity contract must come from your pre-tax retirement savings, meaning a qualified retirement account like a traditional IRA or 401k. You cannot use funds from a Roth account or a taxable savings or brokerage account to buy a QLAC. That's why it's called a qualified longevity annuity contract, because the money has to come from a qualified or pre-tax retirement account. And this is how buying a QLAC allows you to defer RMDs and taxes on your retirement savings. The money that you pull out of your qualified retirement account to purchase the QLAC is excluded from your traditional IRA or 401k when calculating RMDs, which basically means a lower taxable income in your 70s or 80s. In fact, many older investors buy a QLAC exactly for the purpose of lowering their RMDs and deferring taxes. So let's walk through an example. Let's say that I have $1 million in my pre-tax retirement savings plan. For example, a traditional IRA or 401k. I'm turning 73 this year, and I have to start taking my RMDs now. If I pull out $210,000 from my $1 million IRA to purchase a QLAC, the IRS will only calculate my RMDs based on my remaining IRA balance of $790,000, and the lower RMDs may reduce my annual tax burden during my RMD years. Plus, as I mentioned before, I've already locked in an income stream at today's attractive rates that will start at a date of my choosing and will last a lifetime. So, in a nutshell, when executed properly, I don't pay taxes when I buy my QLAC with pre-tax retirement savings. I don't pay taxes on interest earned inside the QLAC while it's growing. I have lower RMDs in my 70s and 80s, and I've locked in a guaranteed future lifelong income stream at today's attractive rates. I will only start paying ordinary income tax when the insurance company begins sending me my monthly checks. 2. At the current time, the maximum you can invest in QLACs across all your accounts is $210,000 per individual. That's up from $200,000 in previous years, thanks to inflation adjustments. Now, there used to be an old rule limiting a QLAC to 25% of your pre-tax account balance, but this is gone. It was scrapped under the Secure 2.0 Act, so now it's just this flat cap of $210,000, plus whatever inflation adjustments will be made in the future, regardless of how big or small your pre-tax retirement savings are. The $210,000 QLAC investment limit applies across all your accounts. But you can combine the limits if there's 2 of you, which means that together with your spouse, you could potentially allocate up to $420,000 to QLACs as a married couple, so long as both of you have your own qualified retirement accounts. 3. You need to pick a start date for when you want the fixed guaranteed monthly payments on your QLAC to begin, and this start date must be no later than the first day of the month following the month in which you turn age 85. So, if I own a QLAC and I was born on September 15th, 1955. I would turn 85 on September 15th, 2040, meaning that the latest possible date for the monthly lifetime QLAC payments to start would be October 1st, 2040. Now, I can start my QLAC payments before October 1st, 2040 if I want, but not later. This 85-year-old cap is non-negotiable, as the IRS wants its taxes at some point. That said, some people choose the latest possible start date after they turn 85 because it creates a guaranteed lifetime income stream at a later age, further protecting against longevity risk and any medical and care costs that may rise with age. 4. You need to pick the start date for your payments when you purchase the QLAC. And the reason for this is because the insurance company uses that start date along with your age at the time of purchase, interest rate expectations, and other factors to calculate the fixed guaranteed monthly payments that you will receive in the future for the rest of your life. Some QLACs will allow a one-time change to the start date for your monthly payments, but this needs to be done before the first checks go out and is not automatic for all QLACs. There may also be some limitations as to how far you can either defer or bring forward the start date. For example, you may only be able to move the date by 5 years or less in either direction. So, if this is important to you, make sure to check that the option is included in your contract and fits your requirements before you sign. 5. A qualified longevity annuity contract is generally irrevocable and non-cancelable after the so-called free look period. Most annuities will have a free look period between 10 and 30 days, during which time you can carefully review your contract once more and cancel without penalty. And a QLAC is no different. After the free look period, though, you're usually completely locked in, meaning you cannot cancel a QLAC, surrender it for cash, get a refund, change the payout terms, or transfer the funds back into your IRA, with the possible exception of the one-time change to the start date on your monthly lifetime payments that we just discussed. Some QLACs may have other exceptions, but if they do, any changes that you will be permitted to make will often come at a high cost to you. So make sure you're 100% certain about your QLAC before the free look period expires. So, as you can see from this table here, a QLAC can offer distinct advantages under certain circumstances. It can help with lowering RMDs and deferring taxes in your 70s and early 80s. It also creates a guaranteed lifetime income stream locked in at today's attractive rates, but starting at a later age, further protecting you against longevity risk and medical and care costs that may rise with age. And if you choose a joint life option, it can protect your spouse as well. Also, for some retirees, knowing that they have QLAC payments that will kick in later in life gives them more confidence to spend and or invest the rest of their portfolio in retirement, as well as the peace of mind that lets them sleep better at night, and might even help with avoiding any rash reactions to the market fluctuations that they may almost inevitably see during their retirement. So, now that you know what a QLAC is and how it works in principle, let's move on to the next part of today's discussion. How much could a QLAC pay out monthly, and who might want to consider a QLAC? So, here are some examples of the guaranteed monthly payments you could get on a $210,000 QLAC, the maximum allowed limit per individual. Let's assume that you're a single male living in Connecticut and that you purchased the QLAC at age 67. This column shows the age when your first payment starts. This column shows your guaranteed total annual income potential for life. And if you opt for a monthly annuity payment rather than an annual one, this column shows the guaranteed total monthly income potential for life, essentially the amount on the check you'll be getting every month once you start taking the income. So, in this example, based on data as of the time of this taping on August 13th, 2026, you may be able to lock in a guaranteed total annual income potential for life of $54,327 from age 80, which equates to a guaranteed total monthly income potential for life of $4,527. As we've talked about in our previous annuity videos, This example is illustrative only, and all else being equal, the guaranteed payouts for women tend to be lower than that for men, because women tend to have a longer life expectancy than men. And they will be lower again for couples if the income is guaranteed for as long as one of them is alive. Also, like for all guaranteed lifelong income streams, the later the checks start coming, the higher they will be. For instance, you can see in this example that if you waited until age 85 to start taking your income, your guaranteed total annual income potential for life could even be as high as $104,210 per year, which translates into a monthly amount of $8,684 for as long as you live. This steep increase happens because the later you take the income, the longer your capital has time to grow, and the shorter the statistical remaining life expectancy. But delaying remains a potentially powerful tool to maximize your monthly checks if you don't need the income earlier. Of course, the reverse is also true. If circumstances change, an investor from the example uses his option to take the income from, say, age 75, the monthly payment would only be $2,644, equivalent to $31,731 per year. Still a nice amount, but clearly much less than if he could wait. Do note that all the payouts in this table assume refund at death, meaning that if you were to pass before the payouts start, not everything would be lost. Your beneficiaries will receive any premium value that is left in the annuity, paid out in cash. Also remember that these payouts that we've shown you here are for illustrative purposes only. Your actual numbers may look similar, or they may look completely different depending on your concrete circumstances and when you're watching this video. Your annuity rate and payout are not fixed until you sign your annuity contract. So now that we've covered what a QLAC is and how much a qualified longevity annuity contract could pay out in some illustrative examples, let's talk about who might want to buy a QLAC. You may want to consider a QLAC if you check one or more of these boxes. You are a generally healthy retiree or pre-retiree in your 60s or early 70s. You know that you have to take RMDs from your pre-tax or qualified retirement accounts, but you don't really need that money. You want to hedge against a super long lifespan. Even if you're someone with other reliable income streams like Social Security, a pension, or rental properties from your early retirement years, a QLAC gives you some extra insurance and peace of mind for the case that you live to 90, 95, or even 100 plus, which would be great, by the way. Plus, a QLAC allows you to lock in a guaranteed future income stream for life at today's attractive rates. As we've mentioned already, rates are at very good levels currently when compared to the past 20 years. Most of our Diamond NestEgg regulars who've purchased QLACs or who are considering them right now do check most, if not all, of these boxes. So if this sounds like you, shoot us an email at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialist, because there's no cookie cutter, one-size-fits-all annuity solution. The generally irrevocable and non-cancelable nature of QLACs makes it even more important to be meticulous in this instance. Any QLAC you purchase should be customized to your individual circumstances, goals, and expectations, and fit properly in your overall portfolio, regardless of size. Please also check with your tax advisor for your personal circumstances, as we are not tax advisors here at Diamond NestEgg. So, with that in mind, let's move on now to the next section of today's discussion. When might a QLAC not be the right fit for you, and what are some key factors to keep an eye on? A QLAC may not be the right fit for you if you check one or more of these boxes. You do not have any funds in qualified retirement accounts. Remember, the lump sum premium that you pay upfront to the insurance company for your qualified longevity annuity contract must come from a qualified retirement account, meaning pre-tax retirement savings, such as a traditional IRA or 401k. You cannot use money from a Roth account or a taxable savings or brokerage account to buy a QLAC. So if you don't have any funds in qualified retirement accounts, you can't buy a QLAC. You have money in your qualified retirement accounts, but you may need to or may want to take all your RMDs, whether that may be for ongoing expenses, healthcare and long-term care costs, emergencies, or any other purpose. In such an instance, you want the flexibility to access every dollar and may not want to tie up your money in something as illiquid as a QLAC. You're afraid that you might not live very long, and or you have health issues that could shorten your life expectancy, because the deferred payouts mean you might not collect much or anything at all from your QLAC. You're an aggressive investor who prefers the growth potential of stocks, real estate, or even some higher risk bonds over fixed annuity returns. A QLAC is generally considered more suitable for conservative investor looking for a guaranteed lifelong income stream starting at a later date in life. You want to maximize the estate for your heirs. QLACs prioritize your lifetime financial security over legacy building. Or in other words, a QLAC will generally not pay out much or maybe even nothing at all to your estate or heirs under many circumstances. Plus, a QLAC will also not hedge you against future inflation. More about that shortly. That said, if these last two boxes here are your primary concerns, do keep in mind that it all depends on how you use a QLAC in your overall financial plan. Plus, you may also be able to tailor a QLAC, like most other annuity products, to your specific needs. So for example, if you're an aggressive investor but want to have the base part of your portfolio covered, as we always recommend, you could invest a part of your traditional IRA or 401k into a QLAC to make sure you have a sufficiently large, guaranteed lifelong income later in retirement. And with that covered, you may have the option to be even more aggressive with the boost part of your portfolio. Or you could add certain extra provisions to your QLAC to tailor it specifically to your needs. Let's look at 3 such riders, as the insurance world calls such add-on provisions. First, a return of premium or ROP rider for your heirs. This guarantees that if you die before the payouts start, your beneficiaries will receive the full amount of your original premium. And if you die after income payments begin, your beneficiaries will receive the unused portion of your original premium. This removes the use it or lose it fear and ensures that your investment isn't lost entirely if you die early. The trade-off here is that your fixed guaranteed monthly lifetime payments will be lower for a QLAC with this rider than one without it. Second, a joint life survivor income rider. I touched upon this briefly in the previous section of today's video. A joint life survivor income rider extends lifetime income payments to 2 people, typically you and a spouse. Payments continue for as long as either one is alive and ensures that the surviving spouse is financially protected. The trade-off is that the payouts on a QLAC with a joint life survivor income rider will be lower than a single life QLAC because the insurer expects to pay for a longer period of time. And the third is a cost of living adjustment, COLA rider. QLACs, like all fixed annuities, typically do not offer inflation protection. The guaranteed monthly payouts are fixed for life, so rising prices will eat away at the purchase power of those regular QLAC checks over time. So, if inflation keeps you up at night, a COLA rider may be something to consider. A COLA rider typically increases your future monthly payments by a fixed percentage, often 1% to 3% annually, after payments begin to help offset inflation. The trade-off here is that your initial payments will usually start off lower, but they will grow over time. Now, all of these riders are optional, but personally, if I were to buy a QLAC, I would seriously consider these first 2 riders. The return of premium rider, because I would rather pay a little bit more to make sure that my hard-earned premiums go to my heirs and not the insurance company, even if I died an earlier death than expected. And the joint life survivor income rider, because, well, I'd want to make sure that Marcus is financially protected as best as possible if I were to pass before him. Now, this COLA rider is a bit more complex. Some QLACs may offer a bit of built-in inflation adjustment at certain levels without any additional costs. If the inflation adjustment was of no additional cost to me, I would take it because, well, it's free. If I had to pay for the COLA rider, or if I had to accept a lower guaranteed fixed monthly payment in the earlier years, which economically speaking has the same effect, I would not go for a COLA rider. Historically, and on average probably still now, COLA riders are just too expensive, at least in my mind. I would buy a QLAC for what it's designed to do, to lower my RMDs and to ensure a fixed, guaranteed lifelong income in my late 70s and early 80s. Basically, to establish a floor for my income. I would not buy a QLAC for inflation protection. In my mind, there are other and potentially more efficient and effective ways to protect myself against inflation in my older years. For example, by allocating a portion of my fixed income portfolio to Treasury inflation protected securities, TIPS, and I-bonds, or by leaving the equity part of my portfolio in low-cost index funds that are suited to my risk-return profile. But as I always say, everyone's financial journey is different. QLACs, like all other types of annuities, are not for everyone, but for generally conservative investors who are looking to lower their RMDs, defer taxes, and lock in a guaranteed lifelong income stream later in life. There's no other product out there like them, especially with how attractive payout rates are currently. That said, your QLAC should be specifically tailored to your needs, from how much you want to contribute initially and when the payout starts, to whether you want to add your spouse or include some of these other riders that we've just talked about. So email us at jennifer@diamondnestegg.com so that we can connect you with a trusted annuity specialist to discuss what may be right for you. And for those of you who are interested in other types of annuities, especially given where rates currently stand, check out our annuities playlist here, where we dive deeper into single premium immediate annuities, multi-year guaranteed annuities, and fixed indexed annuities. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again soon with more brand new wealth building content for your financial journey.